Wow, guys, check it out. The TradingView has the Dow Jones Industrial Average, the GJI, with daily candles, sort of with this kind of fake green data of the Great Depression blow off. And the Great Depression is this whole period down past the reversion mean and back up. And I want to try to map this bubble with my model, do some Elliott waves, all that stuff on this green Great Depression thing and see what we can get. So here's our Great Depression version of the .com and the financial crisis. Just like we saw in the Nikkei, you get this double bubble and a crash, and you get this nice little trend line up to that one, and then here's the Great Depression Volmageddon double bubble with the crash. September, and that chops the dead cat, and then we get a waterfall. The Nikkei did that too. It had a huge waterfall off of the second one, and I have, yeah, okay. Well, let's just throw the next one in there too. Oops. And so the long-term bull market line is kind of here, and it seems like we need a better. This line should be crossing that one. It should be like here to set up the bull market for that one. It should be like that, because the steeper trend line needs to break the other one and then go steep, and then this one as well needs to break it here. Okay, this is the Volmageddon top for the Great Depression. Where the actual bull market trend lines get steeper is where you get those where you get the crashes. So you get the very long term, and this seems to work on all of these sovereign debt bubbles. You get the very long term bull line on the yearly scale here, and then you get this steeper line that kind of gets you in on the monthly timeline, and then you get a steeper one that gets you up to the blow off top, and you get sort of like a weekly. Um, Very cool. So let's get in here and start taking a look at this thing and see what is going on. Yeah, so both the Nikkei and the Great Depression had a huge waterfall underneath these. So if I want to label these ones, this is like the Volmageddon line, and this is like the financial crisis line, and this is like the Volcker line that I have in our model on the current S&P. Volcker is VLL. It's kind of funny. So this is Volmageddon and financial crisis and Volcker line, kind of the analogs to those in this crash. And then we can see the kind of activity that we got here. So, I mean, I can't really get tight enough to see like a 5 wave looking thing or something here. This is pretty vague, but let's just kind of look at the general idea. So, I mean, what we generally do when we're unwinding a debt bubble is you break it, you back test it, and then you swing out and test it again. And it looks like that's what we get here. Break it, back test it, down pretty good, and then we get up here and test it again. And then usually you get a little dead cat beforehand, and then you break it, back test it, and then you swing out and you test it again. So the Great Depression is not getting double tops like we are seeing in the Nikkei and the S&P. It's just getting single touch back tests, which is different, but we are getting the immediate back test and then the swing out back test, which is not too surprising. And the whole support trend line thing works perfectly, and just the general idea of breaking and backtesting each one of these, break it, backtest it, break it, backtest it. And then if you draw, instead of just saying that, if you draw the Elliott wave shapes, let's get out a little bit further and I'll show you the main Elliott waves. And I don't really, oh, well, on this one you could probably do it. So here you get the 1, 2, 3, 4, 5, the Elliott 5 wave here. And that's what we have been seeing in the Nikkei and the S&P is that these kind of bull trap movements are Elliott 5 waves, and these downward movements are the 1, 2, 3 corrective waves. And let's go. Let's do some waves on the Great Depression. Okay. All right. So it looks like the large time scale we get a 1, 2, 3, and this looks like the bottom of unwinding these steepening bull market trend lines up to the bubble. So what usually happens is you unwind the bubble, and this is basically the end of the bubble, but then there's a bear market that follows that, and you go sort of to a mean reversion trend line here, but usually you break below the mean reversion trend line and come back. And right here is basically where the Great Depression ended. It was after we got back up to the mean reversion. And this was all a monetary contraction. This is a sovereign debt bubble. And this sovereign debt bubble was the domestic, fractionally gold-backed U.S. Federal Reserve dollar. And we can get back, well, not that far. But anyways, the Fed was 1913. World War I was 1914. And then this whole situation here is the roaring 20s, up the bubble, roaring 20s. And then the whole backside of this bubble here is the Great Depression. So that's really all a depression is. Like you get smaller cyclical monetary contractions, and those are recessions. The backside of a small monetary cycle is a recession. But when you get like a big one, like a sovereign debt bubble or a very long-term credit cycle that contracts, then you get the backside. The backside of that bubble is what a depression is. And this is the Great Depression. It's the backside of this bubble. And then pretty interesting, we unwind on this thing in basically 31, and 3 years later we're out and we are back to mean reversion and going up and becoming the international world reserve currency after this. And right here, after we get out of the Great Depression, is when Roosevelt confiscated the gold, and then 34 also confiscated silver. And then the United States was stockpiling gold and silver this whole time. They were making loans to all the other countries that were fighting in the wars and just got a mountain of gold. And then by the end of World War II, America had, and that's in 40 something, 44 was Bretton Woods, right? I think around here, it was near the end of World War II where America had a mountain of gold and all the other countries didn't have a bunch of gold, and everyone was using gold-backed money. So America came up with the agreement that you can back everyone else's currency in US dollars, which are in turn backed in gold. And that is the official beginning of the United States as the world reserve currency right here in 44 with Bretton Woods. And that is also a gold-backed Federal Reserve dollar. And that's the worldwide Federal Reserve dollar, which didn't stay the reserve currency that long. And I can go and talk about that a little bit too. But let me get in on these Elliott waves a little tighter. And so we get the ABC corrective down wave, and this is the huge one that breaks all three trend lines. But if we get in here, there's also there's a 1, 2, 3 corrective wave here that breaks these two trend lines, and then there's a 1, 2, 3 corrective wave here that breaks just this first trend line. So it's 3 cycles inside of cycles, and each one of these, like the long-term one, the A wave, this entire wave is on the A wave of that one. So it's a whole ABC wave on top of just the bigger A wave, and then you get a smaller ABC wave just on top of the A wave of this one. And there's probably a tiny one on this little guy too. You can't really look at it. But this is the cycle inside of a cycle inside of a cycle thing that Ray Dalio talks about. He always talks about the bull market cycles and the way up, how there's cycles inside of cycles, and you get the longer term. But he doesn't usually talk about the unwinding of those cycles on the way down. And this is where you can see the cycles inside of cycles on the way up is you get this long bull line, and then you get a smaller cycle with a steeper bull line, and then you get a smaller cycle with a steeper bull line. And then once you get to the end, so basically during the roaring 20s, the Fed was just printing up more dollars than the gold backing could handle. And then right here you get the pop, and that is when the collateral goes bad, the backing on the dollar goes bad, and now you have to unwind this bubble down here, and now the bubble's unwound, and then once you unwind the bubble, then you get a bear market correction back to a mean reverted value price, and generally it's going to go below the mean reversion and come back. And in the case of the Great Depression, it only took a couple years to go down and correct. But if you go look at the Nikkei bubble, the Japan bubble, you get this unwinding that's tight just like this, and you break them all three and you get to the bottom. And then after that, the Nikkei took 20 years to bottom and another 10 years to get back to like the mean reversion. It's like a 30-year version of this instead of a 3-year version of this on the Nikkei. And I don't know if that has to do with the quantitative easing and that, but I mean, it looks like after you unwind off a bubble, it could be a couple years to recover, or it could be decades and decades to recover back to a mean reversion point where you can again start a different currency system that is not. Well, I mean, in this case, we went from a gold backing here and just overprinted it, and then once we mean reverted and America had a bunch more gold, I mean, they just revalued the gold and started a new gold back system. And yeah, that's a good look at the trend lines, and you can see these trend lines on my most of my videos. I have all these support lines that you can see, and then I have a bunch of Japanification videos where you can go look at the Nikkei bubble, and it has the same shape with these increasing lines and the same backtesting unwinding here. And this is where we are right now. We're on this spot right here, backtesting the financial crisis trend line on our chart, and the Nikkei and the Great Depression have a really big gap from the financial crisis one down to this long-term trend line, which is the Volcker line in our S&P model. But in the S&P, the financial crisis line is significantly lower than it is here, and it cuts through kind of halfway through here. And we got a really, really deep gash on our first down move here. So it doesn't fit exactly as far as the spacing between the lines, but just in terms of the steepening bull market lines, that's what you see in a bubble, and it seems to be three of them. Like every time, it's the super long-term one, and then the steeper one, and then the blow-off top version. And you could probably get in and find there's probably like even a tinier one that gets right up to the blow-off top, like this. There's probably a tiny one that does this too. And there's probably a tiny little lightning bolt across that one as well, but you can't really get in there and do that, especially on this chart. Anyways, that's the shape of a bubble, and this is the Great Depression, which is a really good example of a sovereign debt bubble. And I'm surprised that this chart is available. These little green guesses at the lines is really nice. And then I can go ahead and look at the history of the dollar a little bit more. Maybe let me switch to different candles and do like an all-time view real quick here. Okay, so I'm out on monthly candles, out on the all-time view, and then you can see the whole Great Depression here. And then this period looks like nothing. This is not an inflation adjusted graph, but if you inflation adjusted this graph, the Great Depression looks a little bit steeper, but this period in here is like a whole inflation adjusted mountain. And this point right here, oh wait, no, sorry. Nope, not there. That's Bretton Woods. That's before the next bubble. Okay, let's get out farther. Right. It's absolutely insane. The non-inflation adjusted graph is just nuts. It just looks like a parabola. And the Great Depression is this little tiny bump that you can't even see. That just looks nuts. So the non-inflation adjusted graph does not factor in the devaluation of the dollar. So this is not really a value graph. This is a value graph on a curve that the devaluation of the dollar, you need to like flatten this line all the way out and take the devaluation of the dollar out of it to really see what it looks like. But around here, 66 was a midpoint, and then 71 here is where he took it off gold. So if you do an inflation adjusted graph, you get like this little mountain where we ran up. The Fed gold backed world reserve dollar ran up to here, and then you get this wind down back to a mean reversion point here. And this is where the gold backing went bad on the world dollar. And so this is the Federal Reserve world dollar, and they overprinted the amount of gold backing it, and the gold went bad. And then you have this kind of gold rush down to the point where Nixon closed the gold window here. And then you have the OPEC agreements and everything here. And this is oh, and I should say that I was a delegate in the presidential election for Ron Paul and a community organizer, and we do our homework on history of money and bubbles and all of that stuff. So I've known all this stuff for 10 years or whatever, and it's kind of fun to just draw it out on the actual chart and look at the wave shapes, the Elliott waves. That's the first time I've ever done any kind of like bull market trend lines or Elliott waves on the Great Depression. It's great. And this line, it looks like nothing. And this period here, they just call this like the stagflation period. But if you inflation adjust it, it's a big mountain, and the values go up and way down. It's just that the value of the dollar in this area is not reflected in this chart. Um, so anyways, 66 or 65 or 66 here is where the gold backing on the Fed World Reserve dollar went bad, and we have this rush down to here. But what happened is the world reserve currency system switched to the euro dollar international banking system right here around like 65, 66. And so, unlike the Great Depression, where we had a really steep wind down and a really fast recovery, this was a slow switch into a different monetary system. And that is people call it like the shadow banking system or the world reserve, the international banking whatever monetary system. It's the euro dollar. The real name of it is just the euro dollar system. You can look up euro dollars and it talks all about it. It's the international banks that loan US dollars to all the international smaller banks and the companies. It's the international credit system, euro dollar. That's what the world reserve currency is now. And it started switching to that system right here in about 66. And then yeah, when Nixon closed the gold window, that wasn't an all of a sudden like, oh, let's just close it for fun or something. Like the gold backing had already gone bad several years earlier, and there was a run on the banks. Everyone's asking for the gold, and there was way too many dollars for the amount of gold, and they're just like, we just don't. That system doesn't work anymore. We don't have enough gold to back all the dollars, and they just closed the gold window and they changed the system. But they didn't announce what it was changing to, and I don't even know if everyone realized what was going on, but the international banks started loaning dollars out, and they weren't gold backed, and everyone says that they are um, like unbacked fiat currency, like an unbacked fiat credit system, and that's not true. Like what it is the OPEC agreement started around here, and that's a big agreement to price all the oil from the major oil producers in U.S. dollars, and it's these international euro dollars, which is the international dollars. That's the world reserve currency that we have right now, and it's backed in oil since it started, in the 60s and 70s, and we wound all the way down to a mean reverted bottom here, even though we switched to another viable system. And the euro dollars are backed, and they're backed in oil, and they're also backed in corporate securities, and they're backed in mortgage-backed securities and real estate. So here is the run-up where the international banking system started printing more money than the world could, than the backing on the euro dollar could withstand. So it was backed in oil, and it hasn't been like a really solid backing the whole time like gold. I mean, oil changes in price a lot more than gold. But we also had corporate securities, and this is the dot-com blow-off, where those corporate securities were way overprinted and way overvalued. There's too much money for the corporate backing, and we get this blow-off. And then this is the housing bubble, where we tested the backing of the mortgage-backed securities on the euro dollar, and we get this crash, and then we get the run up here where we're testing everything out: the oil backing, the corporate bonds, the mortgage-backed securities, all the collateral that the international banking system uses to make all of their international loans. They do have collateral on their balance sheets. They trade them through the through the repo markets, and it's a collateral-based backed system, and the international banks are supposed to be doing, analysis on risk and making loans that make sense to companies that are profitable. But what you see in these bubbles is super, super risky behavior, where they're just making loans that don't even make sense, and it's just getting out of control, and then it crashes and corrects. And the same thing with the mortgage-backed securities here. And then up here, none of that is happening. Like, this is a blow off top of a sovereign debt bubble, just like these last two, where like this is the domestic gold-backed dollar, this is the international gold-backed dollar, the Fed dollar, and this is the international euro banking system, the euro dollar banking system, which is backed with oil and corporate securities and mortgage-backed securities. And the oil is the first thing to go bad. It just collapsed, and that's like the main backing on the euro dollar. So that's why we're getting this crazy crash with this vertical gash to begin. And now we've already gotten through our first two bars. So we have like the financial crisis one here, and then we have the Volmageddon line here, to the dead cat, and then we have our long term, and this is the Volcker bottom. It was in 82 right here, is where we hit like the mean reversion bottom right at the end of those two recessions, where Paul Volcker, he was the Fed chairman, where he hiked up the interest rates to the sky, and that started kind of our whole euro dollar kind of bull run here, like right from 1982. That's that bottom, and that cuts through and gets pretty close to where our bottom went here. And so those are the three kind of ascending support lines. And it's hard to draw really long lines on a non-inflation adjusted graph, but they still work pretty well. And it's the same kind of structure where you get the long-term bull line, and then you get a crash that crosses it and goes steeper, and then you get the Volmageddon. Well, Volmageddon was really this first point in 2018 here, and this second crash was at the end of 2018, but I don't know what else to call it, and I like the name Volmageddon. So these two bubbles here, it's like the dot-com and the financial crisis to this bottom, and then it was the Volmageddon and the second 2018 crash to this bottom. And there's our dead cat. It's right here. Please hit the like button to help me out with the YouTube algorithm. Sorry, this is a long one. I didn't really plan this out. I just noticed the graph was here, and I'm just kind of doing it off the cuff. But we get this long-term bull market line, which you could probably tune in a little tighter to get more reactions through wherever, through here kind of. And then, yeah, Volmageddon, financial crisis, and then that's what we're up here backtesting right now. We're up here backtesting this financial crisis line right now, and we're underneath here. And so relative to the Nikkei chart and the Great Depression chart, as I was saying before, it's not quite as big of a drop from our financial crisis point to this point, because those ones, it was just a major drop to the next line, and these are more equally spaced. But this is the next target, and we have done all this stuff already. And you can go and look at most of my videos. I mean, I do I do the S&P version of this one all the time. The S&P is a little better graph because it's more of the big companies, and you can really see the monetary system contraction kind of mathematical shapes, and you can draw the lines better. But as I get in there, you can draw tangent lines like along the waves. You can do tangent lines from like end to end of a wave, and you can do these support lines, and then there's just different tangent lines that you can draw, but I don't have any horizontal kind of support levels. Like, they don't really exist. All of the support levels are these angled kind of bull market lines and tangent lines and that sort of thing. And then we get the same behavior, which you can't see at all on this. All right, let me just switch down to like, I guess, yeah, I'll just go down to like 1 hour candles, and I'll just draw some waves on this too. May as well just do it in this video. Give me a sec. Okay, so here's our chart. Let me bring these lines back in a little bit more. So when I lay these lines out, I like to lay them underneath the peaks and kind of across the meat of the action here. Oh, wow, where's this thing? Way out here. Okay, let me pause it again and I'll bring these back in. All right, so I brought these yellow lines back in where I can see them. And this white thing up here, that was the circle that I drew on the other thing. It looks crazy. So let's get another little circle. So this is the pop. This is the pop of the everything bubble, where the oil backing and the corporate backing and the mortgage backing of the euro dollar world system went bad, and now we're unwinding this bubble. And the Dow Jones, I've never done a Dow Jones version of this one, so this will be cool. The Great Depression, uh, because, well, in 1929, the Dow Jones really was the stock market. Like, you get the real picture of the stock market, and now the Dow Jones is not really the stock market. Like, you get the S&P is the big stock market, where you get the really clear lines that you can draw perfectly. But the Dow Jones is pretty good. So let's take a look and see what we have. So let's get in here. So this is our Volmageddon line, and this one is the financial crisis line that we're underneath now, and this one is the Volcker line. And the Volcker line is the long-term bubble line. And so we get this same kind of thing where you get a dead cat above the line, you break it, back test it, and then you kind of swing out, and usually you get a double test. The S&P, we're getting double tests of the line and then reverse. And then you do the same thing. You get a dead cat here, break it, immediately back test it, and then you swing out, and then you do a double test. And that's what we have been getting so far. And it's the same thing on the Dow Jones. Even with less data, it still is pretty clear that what the pattern is doing. And so the Volcker line is our bottom support line of the long term, the bubble. So the next move would be the same thing, where you go, and it's going to be a steeper angle, but it'll be the same kind of thing where you get out here and you get a dead cat, and then you break it, and then you immediately back test it, and then you would get out to a little swing, and then you could get out to this thing, and then you could double test it. And this is a longer timeline. This last part of the bubble, just kind of based on the shapes and the angles, this looks to me like it's going to be right around the presidential election time, when we're testing this thing again. So, I mean, we should get a big crash here, and the next month and a half, like this bottom here, is about less than 2 months to get to here. And I think that we may have reversed already today. I haven't really checked the markets, but once I checked the Nikkei and I saw these double tops and I did that pattern on our graph, I'm like, oh, okay, we just need the end of this 5 wave. So this is an Elliott 5. This is a 1, 2, 3, 4, 5. It's an Elliott 5, and it's the 3, 4, 5 that looks like the double top. It's just an Elliott 5 wave, and you get one here on this little one, and you'd get the same thing again here. You'd get a 1, 2, 3, 4, 5, and the 3, 4, 5 is the double top. And that's what we're looking for as far as the Elliott waves go. And then if you draw the sort of Elliott correction waves on this one, you get the big pattern, which is this one. You get one, two, or ABC, sorry, the ABC correction wave here. And then along the A leg of that one, you get an A, B, C correction wave. And then along the A leg of that one, you get the same thing, a A, B, C correction wave. And then this thing, if this all the way out to the presidential election is a bull trap underneath this one, then that's not the last leg. There's another one, a fourth layer that goes A, B, C, and it wouldn't be that steep. It gets really flat once you get out on this timeline. It would be A, B, and then a C that would run out. Who knows? That might be like 2 or 3 years just to unwind the everything bubble, and that's just the tight waveforms of breaking these bull market lines. And then after that point, that's when you would start your switch out into a bear market where you get down to a mean reverted bottom and come back. And on this timeline, that looks like it could be, who knows? I mean, on the shorter end, if it does it like the Great Depression where it's fast, that could be like 5 years to get to the bottom and mean revert. But if it's like the Nikkei version where it took them 20 years to get to the bottom and then another 10 to get to mean reversion, like that was 30. This could be 50 years or something, somewhere in the 5 to 50 year range of bear market activity, and really kind of flat bear market activity where it just mostly goes sideways, but each bottom is lower and you keep kind of just going down a little bit. So that's what the cycle looks like comparing to the Great Depression on this one. I mentioned the Nikkei a couple times. If you want to see those, you can go look them up on my channel. But that's the anatomy of a bubble, and then you can draw the emotions that people are feeling at different points of the bubble. But this big timeline is how we unwind the bubble. So if you're gonna write like, the denial and the fear and back to normal, it's on this big timeline. Like this whole thing here is the denial phase, and that gets all the way out to like the presidential election. And then this is the return to normal, which is the B wave, and then you get all those, fear, capitulation, whatever, down the backside of the C wave. And you could go and write those on these waves too if you want to do that. Yeah, so I mean, people say that kind of anatomy of a bubble graph with all the feelings written on it is kind of outdated and doesn't apply. And I have a model here that says that it does apply. And this is the pattern that I see happening right now. And I actually don't see any of the health situation in here. It has nothing to do with the news, or, I mean, like the financial reports that are coming in definitely do matter, but the stock market doesn't react to those reports. Like those reports are a consequence of this monetary system contraction. How much money is available to the companies? The whole private sector is pro-cyclical. It's just how much business they can do depends on this currency system expansion and contraction, and you get these little cycles all the way, but this is the big one, and the big cycle, we're on the backside of the bubble now, and that's why you get this insane rip like this. And that's where we are here. I mean, we're still pretty high up in this bubble cycle. And I mean, if I zoom out, I'll zoom out again and look at it farther out just so you can see for perspective. Okay, I'm out on like a yearly chart with daily candles here. And so you can see here's our increasing bull market support lines, and we've broken this one and back tested with the dead cat. We've broken this one and back tested it with our first bull trap. And then if we break this one and test it, it doesn't, once you kind of zoom out, it doesn't look that super long, but this does go all the way out to the end of the year. And then the C wave would be, somewhere over here. I don't know the prices because it kind of, like, these might be too deep. It kind of gets more flat and more sideways as you get into the longer term ones. But It's not really a price model. The timing is a little bit easier to guess than the prices, but we do have these support levels to see where we're going to break. So these prices are easy to guess. Where we're going to backtest is going to be right around where this line is, based on the bull market line, just like these ones. But yeah, as I was saying, like this is the point that we actually have to get to unwind the whole everything bubble. And then after you unwind the bubble, you're not quite done. Every time the bubble unwinds, there's sort of a mean reversion value line that you're still above. And like as we saw in the Great Depression, it took us 2 years to get under and get back to the mean reversion and start over. But in the case of the Nikkei, it took 20 years to get down and get back, or 30 years to get down and back up. And the Nikkei, went pretty far down, but it took a really long time. And people say the Nikkei like trended sideways, and it didn't. It went down, 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 down. The Nikkei went from like 24 down to 7. Like it went way down, and then it finally came back to the mean reversion area where you can have growth again. But that's kind of how the bubble unwinds, and it's really cool to actually get to draw analysis and waves on the Great Depression. I didn't realize that I could get that chart and actually do this. So this is a really cool one. Sorry if it's really long-winded. Please hit the like button for me. And this is not financial advice or political advice or anything like that. And I just wanted to point out how sort of the monetary system expands and what it looks like when it contracts. And sort of what happens when it's contracting is the money is in fact backed by something, commodities. I mean, the taxes in the military play a big role in circulating the currency, but it is backed. It has been backed this whole time. And it's backed by oil and by corporate securities and by mortgage-backed securities. And those are all junk now. The oil is junk, and now the corporate securities are becoming junk. Like all the corporates all over the world are becoming junk, and then the mortgage-backed securities will be next. So, I mean, that's a long-term look at this cycle model on our current, and this is on the Dow, which is cool because I probably won't come back here to the Dow and do this kind of analysis on the Dow again because I just focus on the S&P because that's really what our stock market data. You get the best data and you get the cleanest lines on the S&P. And then if you go to individual sectors and individual stocks, like you'll see the same pattern, but it's kind of like droopy and it's not tight like this. You need like the big aggregate of all the data to really get the tight lines and follow the cycle. But yeah, this is not like a couple companies making a mistake or like, and I don't even see the health situation in this chart. I mean, maybe the depth that we dove on this one, because we didn't have to dive that far. We could have, come down low, like we could have come down in here and then gone over. So maybe the depth of this line and the angle back up has to do with the health situation. But other than that, I just don't see that in here either. Like this is just a monetary system contraction off of a 3-level kind of expansion bubble, and you just get the unwinding, you break and back test, break and back test, break and back test, and then you get the bottom, and then you can go into your reversion phase. And I guess from the point of value investing, people keep mentioning value investing, and they're up here, you know, trying to buy value stocks or even dividend stocks, and this is not the time to try to get value here. Like the value is here at the bottom of the whole thing, and I don't even know when that is, like 3 years from now or something. And this whole time is going to be a deflationary contraction cycle where there's less and less money available. And the money that the Fed is printing is just trying to fight the deflation. Like they're not stimulating or pumping anything. And they did the same thing in the Great Depression. They were buying stocks and they were printing out money. They did all that in the Great Depression. Japan did all of that stuff during the Nikkei bubble. Like their central bank is super famous for quantitative easing. Like Japan is the quantitative easing bank. Like they pioneered quantitative easing, and they did it the whole time they were trying to intervene, and it didn't change the shape of their down cycle at all. And it may have changed the shape of their recovery period because they did quantitative easing aggressively for that whole time. And then possibly instead of a 3-year recovery, it's a 30-year recovery because of all the quantitative easing. Um, but yeah, the quantitative easing doesn't change this cycle shape, and the news doesn't change the cycle shape, and the financials are a result of this, not they don't cause it. It's just the monetary contraction. It's a mathematical cycle, and you can draw your mathematical tangent lines all over it like we used to do in high school calculus. And the Elliott waves are really cool. I didn't even know the Elliott wave theory or anything when I started working on this model, and the Elliott waves are fit right in. And I mean, I knew they were mathematical kind of wave shapes, and I was just drawing tangents and stuff like that. But the Elliott waves are like, oh, okay, that's like this type of Elliott wave, and it fits, and it's pretty good. So I really think it's cool. There's some waves and some cycles, and I guess I could also mention the, I don't know, is this like a 20-minute video or something? I could mention the cycle data that we have. So the cycle data that we have on the monthly level is just showing a 3 to 4 month credit contraction cycle that we're about halfway, maybe a little under halfway right now. So the credit contraction cycle just basically says you're on this A leg down. And this is a bear market credit contraction cycle, so it's a steeper line down. And then in a credit contraction cycle, you get a down move, and you get like two bounces. And so that was the start of this channel. I was just talking about that kind of down bounce kind of credit contraction cycle thing that I was looking for. And the more I've worked on it over the past month, I've like really got all of these support lines and the shape of the bubble and the waves and all this kind of stuff in here. So who knows what I'll have in another like 3 weeks or something. Um, but I am well, 80% of my portfolio is just cash and treasuries, just safe away from this stuff, and I hope that's safe. I mean, who knows what's safe right now, but the 20% that I am speculating with right now is short, and I'm short tech and mostly tech right now. Yeah, I had some oil shorts, but oil already came down, so I sold the oil shorts and I got more tech shorts. And I also have Tesla shorts, which are killing me. I got the Tesla shorts too early, and Tesla went way up. So um, we'll see if this thing comes down. I'll just try to kind of get out of the Tesla shorts. I don't know. It's gonna be hard to make. Well, I mean, if it comes way down here, it's not gonna be hard to make money on them. But I want to try to trade this dead cat bounce, and I want to trade this back test. All of these moves. We know the moves. We know the shape of this thing. Um, so just try to figure it out, and just, you can day trade and swing trade with this data, and you can long term invest. No, I don't know. How do you inverse like long term invest? Because anyone that talks about value investing or long term investing says that you buy at a mean reverted bottom price. And right now, we're close to a mean reverted, like highest valuation in history nonsense price. So there's really no value investing to do right now. It's just try to protect and try to short with a speculative amount that you're comfortable gambling with, basically. And then yeah, and then the other trading strategies that I talk about on my channel with trading gold, or like the oil tankers right now, are really cool. It's kind of like an inverse thing where the the petrodollar and the oil and everything crashing um, is good for the oil tanker companies. So that's like a long, maybe through the whole cycle, that would be really good. And so I'll follow all that stuff and try to find some interesting things. Or like metallurgical coal, I've heard is a really good sort of commodity thing. Like that might even be good to get into here. I'll go look at that kind of stuff. Um, but we'll keep it coming. We got tons of oil tanker videos out this last week, and people are asking me for follow-ups and stuff, which is great. And that's enough. Sorry, this is a super long one. I didn't mean to go crazy. I just saw the Great Depression chart, and I got like excited and started drawing lines, like like I do. So this is not investment advice. Please hit the like button. Happy trading.